Right, I'm not quite sure if my maths is correct, and our next guest will certainly probably point me correctly, but I saw a $50 billion budget where 1% of it was tagged to an industry that brings in $46.5 billion in export earnings a year. That is all I can go off, as there is, of course, not many specifics around the infrastructure spending, environmental support on farm, job training, etc. That's extra to that, which the primary sector welcomes, that it can have a slice of. So to talk numbers, we're joined now by economist Cameron Bagrie on a day that probably, I don't know whether it's like Christmas or not, economists poring over and crunching numbers to do the great job of helping us understand it in layman's terms. Cameron, firstly, how's today been?
Oh, it's been busy. I've got some lovely feedback from a few sort of characters out there that disagree with my assessment of the budget being about borrow and hope. So lovely emails to receive in an afternoon and evening.
Well, I think there's probably the blunt truth that people are trying to stomach, to be fair, Cameron, and thanks for someone like yourself that is actually there to be able to give us those hard, cold things to be able to swallow. So firstly, I really want to understand, the legislation around and fiscal responsibility that's in place for our finance minister to create such a slush fund in such a short amount of time. We heard that budgets are normally prepared in 6 weeks in advance. This was finished on Monday.
Yeah, and in fact today, they couldn't even give us all the detail in regard to what a lot of those announcements were. Apparently we're going to get them on May 22nd. So that just gives you an idea about how hurried some of the stuff has been. Now, look, to be fair, extraordinary times calls for an extraordinary policy response. And we've seen that. And they did need to go fast, and they did need to go hard. My concern out of this is that I think strategically they're making the right move, leaning off the government balance sheet. There's going to be a debt problem down the track, but we'll deal with that down the track. My real concern here at the moment in regard to whether it's turning into a little bit like a confetti-style budget, because the money just seems to be flying out the door, and I'm not quite sure where all it's going or whether it's going to be quality on the other side, because there's some big numbers floating around. The COVID response package is 62 odd billion. Now, about 40 billion of that has already been spent. There's about 20 billion left. On top of that, the budget package today was another 15 billion. Government debt, net debt, is going from about 65 billion to 200 billion in the next 4 years. Now, those numbers are absolutely eye-watering.
So, coming back to that, how are they able to present a budget and get it passed by all members of the House, or a majority of the House, without detail? It seems to me so irresponsible.
Well, there is. We got the bigger picture detail. So we know that there was the wage subsidy scheme was 3.2 billion. There's about a billion bucks to create jobs, and the environmental side of things is we can go through, with reasonable accuracy, a lot of the stuff. And then credit where credit due. New Zealand's actually pretty transparent in regard to what takes place, because the public demands that transparency. And look, my personal view is that the government is doing the right thing by borrowing and borrowing big to try to insulate New Zealand from what is the last time we had this sort of event was the 1930s. It's way worse than the GFC. It's way worse than the Asian crisis. So yes, we're throwing money out the door. We're putting it on the credit card. We're loading up the checkbook, loading up the credit card. But someone's going to pay for this on the other side, and it's going to be the next generation of taxpayers.
Okay, so what has been some of those things that you've been critiqued for saying today across the news?
Well,
that people aren't liking, that people aren't really liking.
So if I have a look at what I really wanted to see in today's budget, was not just a big package. Right, we got the big package. We saw the extension of the wage subsidy scheme. They're going to be investing more in infrastructure, 400 billion to tourism to help them out. They're pulling all those levers. What I also wanted to see in this budget was, I guess, a little bit more strategy, a little bit more of a plan, a narrative, a story around where New Zealanders is going. Now, to be fair, it's pretty hard to create that narrative or that story when things are evolving by the day and there's so much uncertainty over COVID. Yeah, but I still think we needed something to give New Zealanders a bit of an idea about what that reset, that rebuild that the government is talking about. Well, what does it actually look like in reality? What we got today was a whole lot of numbers, some real big spending, but not a controlled narrative in regard to what that plan actually looks like.
Yeah, excuse me, and what the new New Zealand will look like, and some vision for us and what we can stand behind, being proud of. Now, I'm also really concerned as well about James Shaw's language, which surprised me from him. Excuse me. That we have a this is his words from Jack Tame's budget special, we have a very narrow range of tax take in this country, so everyone who benefits from this recovery must pay for it. It's not a hell of an incentive, especially to the primary sector who want to be that light that pulls us through the recovery.
Well, yeah, the agriculture sector is still the backbone in New Zealand, so they're going to be pretty damn important on the other side. You'd hope we'd be pulling more levers, looking at trying to get more growth out of aquaculture as well. Maybe there's some selective opportunities in manufacturing. Going back to what James said, do we have a narrow tax base? Well, the answer is yes. If we started from square one, we probably wouldn't have the one we've got. The one we've got is actually reasonably good compared to other jurisdictions around the globe. But if we start with a blank canvas, we would make some changes. But I think he highlights an interesting point, which was not in the budget today, is that someone's going to pay. If we load up the balance sheet, so government debt goes to 55% of GDP, and nominal amount of debt out there is 200 billion. In the next 12 months, the government is going to be borrowing 60 billion. That's more than $1 billion a week. So the numbers are absolutely massive. Now, at some stage, a couple of years out, we're going to have to get those numbers back down. And we can do it in a number of ways. Way one is to go more stringent in regard to spending. Now, I don't think the incumbents are going to be too keen on that route. Option two is to get the economy really fired up. If we can get the economy really fired up, strong economy means people paying tax, then we pay down the debt through that channel. Have we got a plan yet to really get the economy fired up? It's absent. The other final choice is that tax rates go up. You want to be saying you're going to be putting up tax rates in an election year. But if I look towards 2021, watch out.
Oh, absolutely, totally, and then that was made as a comment as well as by Simon Bridges that watch out, the kindness will disappear from this government going into the next term. On those levers and what the Treasury and the Reserve Bank are doing and could do more, the response committee meeting that you opened, and there were several other independent economists on there as well, had differing opinions around what if a negative OCR was actually palatable or not. What's your thoughts on that?
I'm not a big believer in negative interest rates. In fact, I think it's sort of Humpty Dumpty economics. It hasn't exactly worked in Japan, it hasn't worked in Europe. There's a real fine line here because interest rates and financial instruments, if they're left unchecked, give you an idea about the balance between risk versus return. As soon as you start seeing central banks, governments interfering in markets, you interfere with what's called the process of price discovery. Markets do not accurately reflect the value of the instrument that you are buying. And if I have a look at in New Zealand at the moment, the Reserve Bank's stepping up to the plate and they're buying a lot of bonds. They're keeping them lower, interest rates lower than what would otherwise be the case. Now that's a good thing in regard to keeping interest rates low, but what it is also doing, and we're seeing in an awful lot of other jurisdictions around the globe, you're distorting the price of the instrument. It does not accurately reflect what the value is, I think, of that asset. Now, you can do that temporarily, but I'll be really worried about doing that for an extended period.
And the market's reflecting that with, of course, the New Zealand dollar, which is hopefully going to be able to buffer some of this for our exports.
Yeah, well, the New Zealand dollar has come down a little bit of late, and it's on in what you call the more exporter friendly zone. And generally speaking, when it's up in excess of 65 cents, that's the exporter unfriendly zone and the importer friendly zone. Sort of around, the mid 60s, both are pretty happy. As soon as you sort of get down below 65 cents and with a 5 in front of it, well, that's export friendly and it's importer unfriendly.
Yeah, absolutely. And but the thing is, at the same time, it's just a true reflection of how our markets are not in a good position, which we need them to be. And there's a lot of worry around the state of the US and the UK, our major markets, as well, to be able to bounce back.
Well, currency is a two-sided coin, right? And quite often the New Zealand dollar can be high because it's got nothing to do with us. It's got everything to do with the US dollar. I can remember the New Zealand dollar got down to 40 cents. Had nothing to do with us. It had everything to do with the technology bubble we had right back in 1999 and 2000, and the US dollar was the only game in town. Yeah, what do we know? The New Zealand dollar of late is trading off a risk aversion theme. So if risk sentiment is good, i.e. equities are going up, then the New Zealand dollar tends to go with it. If you see equity market sentiment start to wane or risk appetite start to look a little bit flaky, then the New Zealand dollar as a risk-based currency tends to come down on the other side. Now, the good news with that is that it's exporter friendly. The bad news is if risk appetites are looking a bit frail, it's not telling you a great signal about the global economy. And what we also know is that when the global economy is soft, commodity prices tend to go down, not up.
Yeah, and on that, Fonterra on the 1st of June is set for their forecast. ANZ's come out dropping it another 70 cents. What's your thoughts?
Well, at the moment, I'm in the low sixes. My concern is it ends up with something in the 5 in front of it. I've actually been really surprised at how well GDT prices have held up over the past 2 to 3 months, given what we've seen around the globe. But if we see the global economy continue to look shaky, and particularly the consumer in the back half of 2020, then you've got a recipe for those prices to continue to slide. The good news story is that the New Zealand dollar is moving down with it on the other side as a bit of a buffer.
Yeah, absolutely. I just want to talk about going into this election 4 months away, and having this earmarked spend pre-election. To me, saw Simon Bridges sounding very politicking today. It's like the election campaigning already beginning, yet unable to come up with a solution in the details what National would have done. How do you think this next 4 months is going to play out around economic recovery between the two major parties?
Well, the only certainty out there at the moment is uncertainty. So I'd be pretty wary if I was a political party, trying to come up to the table with absolute clarity, because in all honesty, no one really knows. But what we do know at this juncture is that I think both parties are in broad agreement that yes, we need to be leaning off the government balance sheet. The right response is to be borrowing more, putting money into the economy in the form of wage subsidies, infrastructure investment. Both sides of the political arena seem to have a degree of commonality in that. Now, there might be differences over exactly how much one wants to spend versus the other, but both political parties would be borrowing a bucket load of money right here and now to channel into the economy to support it. Now, I guess we're going to have to start to make a bit of a choice at some stage as we realise there's no free lunch. The more money we borrow today, the more that is a liability on the taxpayer of tomorrow. The big concern I have at the moment is not about the use of fiscal policy or borrowing. It's potentially where the money is ending up and whether we're seeing value.
A return on investment.
Stuff actually going to create jobs. Is the infrastructure investment on these so-called shovel-ready projects, are they going to deliver a more productive economy, or are we going to start to see some interesting projects that you sort of scratch your heads over, i.e. the likes of, they accelerate Ports of Auckland's shift north when really, if you look at the numbers, it should be going south.
Yeah, absolutely. So to close, Cameron, because I'll tell you what, the numbers are through the roof in terms of people watching, yet they're just sitting there so transfixed on all this amazing information. They're not throwing comments out like they normally do. So just to close, what would be your advice to the primary sector amongst all of this massive fiscal policy injection?
Yeah, get a smile on your face at the moment, because the biggest issue around New Zealand at the moment is cash flow. And the rural sector's got it. For an awful lot of businesses that have been non-operational, think about a tourist operator. The cash flow hasn't gone down 30%, 50%. If you're an international operator, the cash flow line has gone to zero. And odds are it's going to be zero for a long time. If you're a domestic operator, same sort of thing. Retailer, okay, level 2. Some people are going back into the shop, but I think it's going to take a long time before that sales line gets back to where it was pre-COVID. Now, we know across the rural sector, there's still some issues. The dairy sector's got too much debt. So if you've got available cash flow, try to pay down the debt. Work with the bank. The bank CEO, I hear bad stories and I hear good stories as well, but generally speaking, I think it's the most, everybody's sort of, one team, one dream. If we get the farmers and the banks sort of working together, we'll come out of this the other side. From a bank's perspective, the rural sector's got cash flow. It's going to be the sectors that don't have cash flow over the coming 12 months that are going to get the most attention out of the banks.
Yeah, actually, all of a sudden, they've just started pouring in the comments. You see, all they need is a wee poke and a nudge. Paul Harris wants to know, Cam, about, golly gosh, they're all moving. How do we get the banks to get an appetite for rural debt again? The price is great, but the rural lending's very low.
Well, it depends which part of rural lending you're talking about.
And I have heard a lot of swing of appetite in some of those banks that were going to be the saviour as well, now running away from touching rural debt.
Well, all the banks in the lead up to COVID were running away from the dairy sector, or at least shutting things down, didn't have any appetite for new customers, would look after their existing customers. The sector's got $41 billion worth of debt. It's 2/3 of total agriculture debt, and about 60% of that dairy debt is interest only. That's a problem. You need to be paying principal. The sector needs to deleverage. Dairy sector debt probably needs to go to 30 to 35 billion. It's not going to happen overnight, but it's probably going to need new capital. If I have a look at what we're seeing in other parts of agriculture, we were still seeing positive lending growth in the last 12 months up until COVID. Now, obviously, what's happened post-COVID is that the banks are still lending, but I guess the
criteria has changed.
They're asking more questions, right? Because it's a different risk environment. Doesn't matter. You go into the bank tomorrow and go ask about getting a mortgage, which is normally the easiest game in town to do in regard to getting a loan. You don't have to tick too many boxes. Well, now you've got to tick a few more boxes because, hey, presto, you might not have a job. So it's a different economic environment. Good deals will still get done. Bad deals, a lot more difficult to push through.
Yes.
Or even mediocre deals.
Yeah, absolutely. No, there's a lot of compliments here saying thank you so much, Cameron, for being able to break this down for us, being user-friendly as always. So I won't take up any more of your time, sir. I know it's been a very big day. And as always, we really appreciate you joining us here on Sarah's Country. It's Cameron Bagrie from Bagrie Economics.
This is Sarah's Country.